Stepping into the world of options. Calls, puts, strike piece, American options. What do all these terms mean? If you are new to the world of options, it can be slightly intimidating and overwhelming, but you will get the hang of it soon enough. In this chapter, you will learn about options and their history, how options trading works, and the basic terminology associated with it. Brief history of options trading. Understanding the history of options will make it easier for you to perceive how options are traded these days. The first known options trade dates to 350 BCE. Thales of Miletus, a Greek mathematician, is believed to be the first option buyer. One season, he predicted the olive harvest would be greater than usual. Based on this belief, he approached the press owners and purchased the rights to use the presses during their olive harvest. He immediately gave the press owners a premium as a lock-in amount to show good faith to reserve his right to use the presses later. The remainder of the predetermined price to use the presses would be paid during the harvest season, as per their agreement. Spring rolled in, and his prediction turned out to be spot on. Since time is of the essence in the olive trade, the farmers were in a rush to reach the presses. However, Thales exercised his right to operate the presses and charged them a higher amount. This is how an options contract works. The tulip bubble of the 1630s is an exceptional example of an options trade. The value of tulips started increasing in Holland during the 1630s. The price of tulip bulbs increased to levels that were neither reasonable nor sustainable. It's quite similar to the dot-com bubble the world witnessed during the early 2000s. The perfect market for futures and options was created in the tulip market because of this simple fact. The bulbs planted by the tulip dealers wouldn't be ready for sale or delivery immediately and would be deliverable only in the future. So, this gave buyers a chance to speculate the future price of tulip bulbs. Because of this, they started agreeing to purchase bulbs at the price when they would be ready for sale in the future. In exchange for this right, the buyers paid the sellers a premium to seal the deal. By paying a small premium, the speculators had the leverage to enter into dozens of contracts to sell tulip bulbs, so they were acquired at a higher price later. This resulted in the tulip mania. Unfortunately, bubbles are not sustainable. The prices came crashing down, and the economy collapsed. Because the futures and options market wasn't regulated, most buyers and sellers shrugged away from their contracts and gave up on their obligations. Compared to stocks, options became a fully regulated investment only in the 1970s in the United States. Before 1973, the options market was incredibly chaotic because option buyers entered into individual contracts with the sellers. Since the terms of every contract were different, there were several standardizations. Once standardization of stock options took place, one contract was believed to be equivalent to 100 shares of stock. Apart from this, the contract's expiration date, strike price, and size were also standardized. The Chicago Board Options Exchange, CBOE, was the first exchange to trade in listed options within the U.S. Call option trading was offered in over 16 stocks by CBOE initially. The Securities and Exchange Commission created the Options Clearing Corporation, OCC, to function as the clearinghouse for all options traded on exchanges in 1975. We have certainly come a long way since the first options contract was created and executed. These days, it is a fully regulated market. Once you understand how options and their execution work, trading will become simple. You will learn more about the basic terminology used in the options market in later sections. What is options trading? While talking about investments, the first thing that comes to mind is trading in stocks. The stock market includes different financial instruments investors can actively use for trading. One of these is options. Options trading is based on the purchase and sale of call and put contracts that are publicly traded on exchanges at a specific price within a specific time frame. Options are legally binding contracts giving the holder of the option the authority to sell or buy a specific number of underlying securities at a predefined price before the contract expires. Options are varied and versatile and help mitigate the risk of an investment portfolio. Once you understand how to trade in options, you can also diversify your portfolio while creating an additional income stream. Options can be used for creating a stream of recurring income or for speculating in the market. Speculation works, especially when you are intuitive when it comes to how stocks will perform. Options are versatile instruments because they involve two parties and are two-sided. Any basic options contract is the 100 underlying shares of a specific company known as the security. As a buyer, you are obligated to pay a predefined premium or fee upfront for each contract you want to execute. Before you jump into trading with options, there are plenty of considerations, especially regarding how and where to invest. Options contracts can be used to speculate the price movement for specific stocks, commodities, indices, and foreign commodities as well. So, the number of opportunities available to invest and trade automatically increases. When this happens, the profitability also increases. The versatility of options and the different types of orders that can be placed cannot be overlooked. Whenever you trade in stocks, there are only two ways to earn money. You can either participate in short or long-term trading. When it comes to options, multiple choices are available as to how you want to make the trades. You must spend time carefully studying and learning the various aspects of trading options. The good news is that it is not at all difficult. Now, this brings us to what an option truly means. Options are derivatives because their value is based on an underlying security. That is what all the option contracts are based on. For instance, ketchup is obtained from tomatoes. So it is safe to consider ketchup as a derivative of tomatoes. Using the same logic, a stock option is the derivative of all the underlying shares it is based on. Options are derivatives, and their value depends on the price of another commodity or an asset. The derivative market consists of different types of investments known as futures, forwards, swaps, and options. Basic terminology. To become an options trader, learning the basic jargon and terms used in the trade is important. Trading in options and understanding the strategies involved becomes easier once you understand the terms discussed in this section. Put option. The buyer of an options contract has the right to sell underlying securities at a fixed price or a strike price with a put option before the contract expires. You have the right to sell stock at a predetermined price within a specific period. The market value of an option is known as the premium. This is the price paid to acquire the rights provided by a call option. Upon expiration, if the value of the underlying asset is less than their strike price, the premium paid upfront is a loss incurred by the buyer of the call. They are under no obligation to purchase the stock for anything more than the existing market value of the stock. Upon expiration, if the value is more than the strike price, the buyer can acquire shares at a price less than the market value to earn a profit. You will learn more about the strike price later. Call option. Unlike a put option, while executing a call option, you have the right to purchase stock at a predetermined price within a given time frame. The writer or seller of a call option is obligated to sell the underlying security at a predetermined price if the option is exercised. The writer of the call is obligated to deliver stock or shares while being paid to take on the risk associated with the same. Exercising the option. If the holder of an options contract decides to invoke the basic conditions, it is known as exercising the option. Whenever a trader exercises an option, they can purchase the underlying stock if it is a call option. On the other hand, the put owner has the right to sell the underlying asset based on the terms already determined by the options contract. All options contracts with an intrinsic value of at least 1 cent are automatically exercised on the date of expiration. Strike price. The strike price is one of the most important aspects of options trading. This price refers to the value at which a trader can either buy or sell the underlying asset or stock. The strike price is not only predetermined, but it stays fixed until the contract expires. While exercising options contract, the underlying security, stock, or asset can be purchased or sold only at the strike price. Hedging. Hedging is associated with reducing the risk of investments. It's a common tactic wherein the investor or trader implements a specific transaction to offset an existing position he holds in the market. Date of expiration. A primary feature of the options market is that there is always a date of expiry for each option contract. This is the duration during which an options contract can be exercised by its holder. If a stock option is listed every month, it stops trading up on the third Friday of every month and expires the next day. If it's a weekly option, it expires on the Friday of the concerned week. Intrinsic value. The intrinsic value refers to the profit you can earn on an options contract if the option is exercised at a certain moment and the underlying asset is either purchased or sold at the existing market price. If the options contract has positive intrinsic value, it means it is in the money. On the other hand, the option is said to be out of the money if it has a negative intrinsic value. You will learn more about both of these terms later. Time decay. All options contracts have an expiration date. This is one of the reasons why they are known as wasting assets. Their time value reduces to zero once they expire. This reduction in value is known as time decay. It simply means, as the expiry date of a specific option approaches, its rate of time decay increases. Time value. All the options contracts include time value. It is one of the most important factors that regulate the price of an option when it expires. Time value refers to a specific amount where the market price of an option is more than its intrinsic value. To obtain time value, you need to subtract the intrinsic value of an option from its existing market value. Premium. The costs incurred to obtain an option are known as its premium. The premium includes its intrinsic value and the time value. The primary difference between the strike price and the existing market value of an underlying security or stock is the intrinsic value of an option. Before the option expires, its value is based on the time value for a given period. Bid price. The specific amount a buyer is willing to pay to obtain a specific option is known as the bid price. If a trader is selling an options contract, it is the premium he will receive on sale. Ask price. The sum a seller is willing to accept in return for an options contract is the asking price. If a trader wants to purchase an option, it is the premium a buyer pays to obtain the contract. Strike price. The strike price is the sum a trader either pays or receives when the option is exercised. Contract name. All stocks have different symbols, and it is the same for options as well. A contract name includes letters, symbols, and numbers corresponding to all the details present within the contract. Volatility. Volatility is the maximum change in the value of stocks between high and low prices, a change in the daily prices of a given stock. When all the past pricing data of a specific option is put together, it's known as historical volatility. You can measure it for a specific time frame or decide to measure it annually too. Implied volatility determines the changes which specific underlying security will experience in the market. This brings us to another aspect of volatility known as implied volatility. The value of options is determined by their implied volatility. If the implied that when volatility is high, the value of an option will also be high. Once again, these are all just projections because there is no guarantee when it comes to trading instruments in the market. It is a prediction of how an analyst believes the value of options contracts will be in the market or how its value might change. Out of the money. If there is absolutely no financial gain whatsoever left to be obtained when an option contract is exercised, such an option is said to be out of the money. Buying and selling shares at a strike price doesn't seem promising, especially when compared to purchasing or selling in an open market if the option contract expires out of the money. A call option is out of the money if the current price of the underlying security is lower than its strike price. On the other hand, a put option is out of the money if its strike price is less than the current price in the market at the date of its expiration. In the money. A contract is said to be in the money if it has intrinsic value associated with it. This highlights the relationship between the strike price and the current market value of an underlying security. The owner of a call option will earn a profit if the strike price is less than the existing market value. If the strike price is higher than the current market value of the put option, it is said to be in the money. At the money. An options contract is said to be at the money if its strike price is the same as the current market value for the underlying security or asset. Holder. The trader or investor who is holding an options contract is the holder. He is the owner of the options contract. The holder of a put contract has the right to sell underlying assets or stock. On the other hand, the holder of a call option has the right to purchase underlying security according to predetermined conditions included in the options contract. Writer. Options writers are investors selling the option contracts. The options writer receives a premium from the holder in exchange for a promise to either sell or purchase the underlying security at a strike price already decided upon by the holder if they decide to exercise the option. The primary difference between the option holder and writer is their risk exposure. An option holder is purchasing the right to either buy or sell underlying security or stock. They are under no obligation to do anything. The options contract gives them the required freedom to decide whether they want to exercise the option or sell it before its expiration. If the holder's option contract expires out of the money, they can walk away from it and let the contract simply expire. It means the loss they incur is just the capital invested and any commission paid to the broker. On the other hand, an option writer doesn't have such flexibility. For instance, if an option call holder decides to exercise their option before the expiration, the writer should fulfill this order and sell the security at an agreed strike price. If the options contract is based on a specific stock and the writer doesn't have sufficient stock or shares to sell, they need to purchase the said security or stocks and sell them to the call holder because they have a legally binding obligation to sell. Spend some time and carefully go through all these terms because they will be used frequently in the subsequent chapters. Unless you thoroughly understand what each of the terms means, you cannot make much sense of the different strategies discussed in this book. Types of options. There are different types of options available in the derivatives market. In this section, you will be introduced to the primary types. Stock options. These options are exclusive privileges that are sold by one party to another and gives the buyer the right to either purchase or sell a stock at a predetermined price within a given time frame. A stock option is a legally binding contract between the two parties. It usually represents 100 underlying shares of a specific stock of a company. Stock options can be either call or put options. If the buyer agrees to buy a specific stock at a predetermined strike price within a given period, it is known as a call option. On the other hand, if the buyer issues a contract giving the right to sell stock at a specific strike price, either before or on the date of expiration, it is known as a put option. The general idea is that the holder or the buyer of the call option believes that the stock price will increase in the future. However, the seller believes the stock price will reduce. This is how they each earn a profit on the contracts. If the price of the stock doesn't increase and the contract expires, the holder of the option will be profitable. This happens because he managed to buy the stock when it was trading at a lower price. On the other hand, if the buyer believes the stock price will reduce, he can write a put option contract to sell the stock later. If the stock depreciates before expiration, the option holder can sell the stock in exchange for a premium. The primary factor that determines the value of an option in all these situations is its strike price. While executing options contracts, remember, the strike price is always predetermined. The call option holder will profit only if the strike price is lower in comparison to the existing value of the underlying security in the market. On the other hand, the holder of put options profits only when the strike price is more than the existing value of the underlying security. It's a common misconception that stock options are the same as employee stock options. Employee stock options don't have a specific maturity date, unlike regular stock options. Whenever an employee works at the same company for a specific period, he's eligible to purchase stock options in said company. Instead of the strike price, which is associated with stock options, employee stock options offer a grant price. The grant price represents the value of the stock at the time the employee received them. Binary options. The simplest form of options you can trade these days are binary options. They are based on a binary proposal of either yes or no. It's one simple question the investor needs to answer while selecting the options. The question is about determining whether the value of the underlying security or asset will be greater than a specific amount at a given time or not. The trader must answer this question with either yes or no. Depending on the answer, he can start trading. There are no complicated calculations involved here. This is one of the reasons why binary options are considered to be incredibly easy to understand and simple to trade. Even though it sounds extremely simple and appealing to new traders, it's important to understand all the benefits and risks associated with them. Before you start trading, it is important to understand that the price of binary options does not exceed $100. While trading, you must be aware of the bid price and offer price. The bid price is the amount the buyer is willing to pay for a specific option, and the asking price or offer price is the sum a seller is willing to accept instead of an option. Here is a simple example of how binary trading works. Will the price of silver increase over $1,000 at 1:30 p.m. on a specific day or not? If, as a trader, you believe it will, you need to purchase binary options at the offer price. If you think the price will not increase, you will need to sell your binary options at a sum lower than the offer price. If the value of silver exceeds $1,000 at 1:30 p.m., the option will expire and you stand to profit from it. On the other hand, if the price reduces, all the money invested in the option will be lost. Index options. Financial derivatives are usually based on stock indexes such as Dow Jones Industrial Average or the S&P 500. Index options share similarities with stock options as they also provide the investor with the privilege of either purchasing or selling a stock index within a fixed time frame. Index options can be in the form of either American or European options. As an investor, you have the opportunity to exercise your right to either sell or purchase the stock before expiration while using American options. On the other hand, if you are using European options, this right to either purchase or sell the underlying stock cannot be exercised until the option expires. The benefits offered by index options are the same as stock options. They also have the added advantage of offering exposure to a variety of securities. Instead of focusing solely on the stocks of a single company, an index option lets you invest in stocks of different companies. Unlike stock options that are settled through deliverables, index options are settled only by cash. The strike price and the premium of index options are expressed in terms of points. Short-term options. As the name suggests, any option with a brief expiry period is known as a short-term option. The duration of these options can range from 1 week to a couple of months and is influenced by the country of issuance. Short-term options are also used in intraday trading, wherein the period is either a single day or a week. If you are just getting started with trading, opt for these options. They are a quick study because, as a trader, you can apply all your theoretical knowledge and gain expertise. It also means you don't have to wait for weeks together to see the results of the trade decisions you make. A disadvantage is that the value of the underlying securities might not drastically change due to the restricted time frame. In case of a loss, the trader hardly has an opportunity to recover from the position and will, therefore, need to accept the loss. This is not the case with long-term investments, where a prolonged time frame allows investors to see whether or not the market conditions will change. By investing in short-term options, you can sell them at any point before their expiry date and earn a profit. To make the most of short-term options, you must understand the basic concepts involved in options trading. To become a successful trader, look for different stock options in which you can invest. Start by observing the trading patterns, general trends in the market, trader sentiments toward a specific stock, and the moving averages. Apart from this, you should also perform a technical analysis to understand whether underlying stocks or securities will perform well or not. Long-term options. As the name suggests, Any option held for prolonged periods of time is known as a long-term option. They are usually held for 1 year or more. If you purchase a call option on February 1st, 2020 that expires on February 1st, 2021, it is a long-term option. An obvious benefit of trading in long-term options is it lets you capitalize on price movements that will take place over a prolonged time frame. Even if the value of the underlying asset reduces initially, you have a chance of recovering from any setback. Long-term options are an incredible opportunity for first-time investors, especially those who are interested in studying the market while reducing their risk exposure. Long-term options are also known as LEAPs, long-term equity anticipation securities. These options are not just available for regular stocks on the market, but for future securities too. Most investors believe that an extra time frame gives them the chance to make calculated decisions about whether they should hold on to the underlying asset or sell their position. For instance, if you are interested in purchasing and holding security, then a long-term investment will be better than a short-term one. On the other hand, a day trader will prefer the short term due to the brief trading period. American options. The American options are incredibly popular and the most commonly used form of options contracts these days. It allows traders to exercise their right of sale at any time from acquiring the option until its expiration. For instance, let's assume you purchased a call option based on the stock of a specific company in December 2020, and this option expires within a month. Now, as a trader, you have the choice to sell this option contract anytime before this 1 month period ends. You don't necessarily have to wait until the option has expired in order to exercise your right. If you believe you have a better chance of earning a profit right away, you can sell it immediately instead of waiting for it to expire. American options are good investment vehicles for those dealing with significant investments in the form of capital in the options market. It offers investors the right to purchase or sell options according to their preferences. If you sell short, you have the option of purchasing the same option again and selling it once it expires. American options allow you to stay invested in the game for as long as you desire while earning profits. Another interesting feature of American options is the date of exercising the option. If the American options are exercised every week, the last chance to exercise the option before it expires is Friday of that week. Similarly, if the American options are traded every month, the last Friday in the last week of the month will be the date when the option expires. Don't be under the misconception that these options are restricted only to the United States because of their name. American options don't have any geographical constraints or restrictions. They are simply known as such because most of the companies exercising this specific type of option are located in the United States. European options. This brings us to the next type of option, known as European options. Unlike American options, the level of flexibility offered isn't high. Whenever you are using one, you have the right to sell the option only after it expires. For instance, say you purchased a call option for underlying security or stocks of a specific company in December 2020, and it expires in December 2021. You have the right to sell only when it expires in December 2021. The right to exercise the option is available only on the date of expiration. Even if the value of the underlying security skyrockets sometime in the middle of this time frame, you cannot do anything about it. You will have to wait until the expiration date to exercise your right. Like American options, European options are also not restricted to regions in Europe, so don't get confused by their name. Exotic options. This category of options includes all options that weren't covered in the previous categories. Exotic options usually come with different privileges and are special. They are commonly favored by high-end investors. These options are quite different from conventional ones in terms of their payment structures, strike prices, and expiry date. They are hybrid securities of American and European options that are customizable according to the needs of investors or traders, and they fall somewhere between these two types of options. A usual options contract gives the holder the choice to buy or sell the underlying security at a fixed price before or on the expiry date. Exotic options contracts have no such obligations. The investor has the right to purchase the underlying security using a call option. Exotic options are usually traded in over the counter markets instead of large exchanges such as the New York Stock Exchange and are commonly used for trading commodities such as natural gas, lumber, and corn. They can also be used for bonds, foreign exchange, and equities. Why trade options? Unless you are aware of why you are doing something, the chance of getting things done reduces. This is applicable in all aspects of life. It is especially true when you are trying to learn something new. Since you are just getting started with trading options, it's important to understand why you want to do this. If you have never given it much thought, now is the time. Learning anything becomes easier when you are aware of the benefits it offers and everything you stand to gain. If you are still trying to understand why you want to trade options, here are all the different benefits associated with it. Benefits of options trading. Buying and trading stocks is easy to understand and perform. The primary benefit of trading stocks is the profitability it offers. Apart from that, they are also quite common and popular trading instruments. All this changes when it comes to options. Even though they have been around for a while, options have only started gaining popularity recently. However, the benefits they offer cannot be overlooked. Capital. A primary advantage of trading options is you can focus on attaining significant profits without a massive capital investment. They are an ideal choice for anyone who has a limited budget for investment. Don't make the mistake of assuming that trading options is a safe and risk-free way to make a quick buck. You can make significant profits with low capital, but it is not risk-free, and it has a learning curve. That said, the profitability offered by options is unlike any other financial tool. For instance, let's assume that you have $1,500. You invested this in a company's stocks that are presently trading at $20 each. You use all your capital to purchase stocks. When you do this, you'll own 75 shares of the company. If the price increases to $25, you earn a $5 share of profit. It means your total profit in this situation is only $375. It's a 25% increase on the original investment you made. Now, let's consider trading options. If you are purchasing call options for the same stock, let's see how it works. If the call option is available at a strike price of $20 and is trading at $2 per share, you can purchase 75 options. This gives you the right to purchase 750 stocks at the given strike price. If the strike price increases to $25, you have the option to exercise your right to purchase and acquire all shares. Once you acquire them, you can sell them for their existing value, which is $25 per share. It means you can sell them all for $18,750. Even though you started with $1,500 in both examples, by trading options, you are left with a profit of $17,250. This is a 150% increase on your capital. This is a basic example of how options trading works. You won't always get such massive returns. That said, the general returns offered by options are quite good. You can make incredibly profitable trades, provided you understand how options work and the different strategies involved. Flexibility. The flexibility offered by options is unlike any other financial instrument. For starters, it is entirely up to you to invest in options as a form of passive investment or active trading. When it comes to investing stocks, there are only limited strategies to make the most of. For instance, if you purchase stocks to create a portfolio and are using a buyer and hold approach, it means there are only two ways the entire investment will play out. You can either purchase stocks, such as data value, which increases with time, or you can concentrate on purchasing stocks that provide regular returns. There isn't much to choose from here. You can even earn from short or long-term investments. You can combine both strategies, but there are only a few variations associated with them. Based on your risk tolerance, capital, and duration, the strategies will differ. For instance, you can opt for a conventional strategy by only making investments where the risks are limited. On the other hand, you must be willing to take massive risks to earn significant returns. Even if you want to trade stocks actively, there are restrictions and limitations that cannot be overlooked. You can purchase stocks you believe will appreciate, or short sell those that depreciate. Even if you put all these factors together, the flexibility offered by conventional financial instruments isn't as good as the ones offered by options. Options can be purchased and sold depending on the underlying security. You can also use options to speculate the movement of stock prices or the price movement of any other commodity, including foreign currencies. Even if you only consider these points, it becomes quite obvious that there are several ways to make profitable trades by using options. For instance, if you have gained knowledge about a specific industry, you can invest in different options for securities belonging to said industry. You are not only investing in stocks, but another financial instrument to diversify your overall portfolio. It doesn't get better than this. As you go through all the different chapters in this book, you will realize there are many strategies applicable to options trading depending on your outlook of the market. Regardless of whether you want to mitigate your risks, reduce the upfront cost, or even earn a profit from price movement in either direction, the options offered were settled. They can be used to hedge any of your existing positions, especially during uncertain market conditions. Options can also be used to make profits even if the market is stagnant, which is incredibly difficult when trading stocks. Yes, you can earn money in a neutral market as well. This is what sets options apart from other financial instruments. Rewards involved. After going through the above-mentioned benefits, you have probably realized that the reward-to-risk ratio is quite favorable when it comes to options trading for structures due to the cost and capital efficiency it offers. Even with minimal investment, you can obtain significant results. The risk and reward ratio offered is better than any other financial tool. That said, unless you are using the right strategy, you cannot reap the rewards you desire. It's also equally important to understand that options trading is not risk-free. Just because it offers good returns doesn't mean there is no risk involved with it. If you want to earn high returns, be prepared to increase your risk tolerance. A wonderful thing about options is you have complete control over your risk exposure while investing or trading. If you take all the different types of options contracts that can be traded and various orders that can be executed into consideration, you can effectively limit the risk exposure of your portfolio. This is one of the benefits options trading offers when compared to stock investments and trades. You will learn more about risk management in later chapters. Risks involved. As mentioned, certain risks are involved in the world even when you are trading options. Despite all the advantages they offer, you cannot overlook these. If you want to be a successful investor, it's important to understand the risks in options trading and take corrective action to rectify them. Let's look at all the risks associated with options trading for stock. Liquidity. Although options trading is steadily gaining popularity, certain issues are still associated with the options market, such as a liquidity filter top. There is a variety of options to choose from, and therefore, it's quite likely a certain type of option is only created in small volumes. In a situation like this, it can become slightly tricky to execute the required trades at the right prices. It is not a significant issue if you are trading with popular options or low volumes. For anyone who wants to trade in high volumes or doesn't want to use mainstream options, the risk of liquidity increases. Liquidity in a market is measured by the number of traders who are interested in transacting in a specific security or asset. If there aren't many people in the market and the ones who are in it are not interested in trading in the option that you want, liquidity will become a problem. Potential for losses. Even though trading options offers better profitability and flexibility than other instruments, it also has potential for losses. You can use different strategies to limit your risk exposure or reduce the upfront cost of acquiring and executing options. And you can also determine the maximum of potential loss you might incur. All this information comes in handy while planning trades. After all that is said and done, the risk associated with investment cannot be overlooked. Regardless of all the experience and knowledge you have, Certain factors will always be beyond your control. Even seasoned investors make mistakes, and, therefore, it's important to understand the different types of risks you are exposed to while trading. Whenever you use the leverage offered by options, you have a chance to increase the buying power of your capital. For instance, if you purchase call options, reward $500 based on the underlying security of stock of a specific company. After this, you earn a profit that is more than the amount invested. If the value of the stock reduces or crashes, the call options will expire worthlessly, and the entire capital you invested will be lost. Here, had you just invested the $500 in the stock of the said company, you wouldn't have lost your entire capital unless the company had gone bankrupt. This is a rather simple point that most investors fail to consider when trading in options. If you want to become a good investor, you must be aware of the strengths and weaknesses associated with the instruments you opt to trade in. That said, certain steps can be taken to reduce this risk. For instance, you can establish stop-loss orders or create a spread. You will learn more about all of these later. Time decay. And the unavoidable risk of trading and options is the time decay associated with different types of options. The longer you wait, or the closer the option is to its expiration, the higher its time decay will be. Any option you hold tends to lose a little of its value. It doesn't necessarily mean the entire value will depreciate over time. That said, the negative effect of time decay cannot be overlooked. Complexities. Whenever you are trading in options, you cannot forget the complexities that are involved. This is also a risk you must consider. Understanding the basics of options trading is easy. That said, certain trading aspects, especially advanced strategies, are not that easy to understand. It becomes even more complicated when simultaneous transactions need to be executed for different positions you want to hold in the market. Do not make the mistake of making trades or assuming positions you don't understand. Unless you have a thorough understanding of the market and the instrument you are investing in, don't go ahead with the option. If you are not careful here, you might end up hurting your financial health. It's quite easy to start second-guessing yourself, especially if it's a new concept or topic. The good news is that a little practice and willingness to learn will help overcome this limitation as well. Costs. The liquidity of the option determines the costs involved in trading them. The price of any options contract includes bid and ask prices. The sum received for writing an option is the bid price. The price paid to purchase an option is the asking price. The asking price is usually higher than the bid price. The difference between these two helps spread and is known as the bid-ask spread. The spread is also an indirect cost that you must consider while trading options. The wider the spread, the higher the cost. At times, the lack of liquidity in the market can result in bigger spreads than you planned. When you compare this with the other forms of investment, the commission charged by a broker and the direct cost of trading is a little high with options. When it comes to trading instruments, certain calls are unavoidable. So don't forget to factor in all these different costs before you make a trade. Creating an option spread has several advantages. One of the most obvious ones is when you are simultaneously executing multiple contracts, you save the upfront costs order fees payable. Once again, the commission payable will depend on the broker or brokerage service you are using. Beware of options trading myths. Perhaps the most common misconception about options trading is that it is extremely risky. Well, to be fair, the risk exists in everything you do, and investments are no different. There is a certain degree of risk associated with every instrument you make. The same applies to options trading as well. After all, unless you are willing to take some risks, you cannot earn rewards. However, you have complete control over your level of risk exposure. In this section, let's look at some popular misconceptions about options trading. Trading in options is a zero-sum game. Trading is not a zero-sum game. If you believe otherwise, it's nothing more than a misconception. Traders usually use youth options as insurance policies or for reducing their risk exposure. Options are also financial tools. and they can be traded like any other instrument in an investment portfolio. From mitigating risk to increasing the diversity of your portfolio, there is a lot to gain by trading options. Different people use different options for different purposes. Some might use it for diversifying the portfolio, others for earning profits or mitigating risks. For instance, there's absolutely no reason to believe that the seller incurred a loss if you purchase a call option and earn a profit on it. Just because one person benefits doesn't mean the other one automatically loses. Perhaps the seller managed to mitigate his risk and made more money than you. So, trading in options can never be a zero-sum game. Profitability is associated with purchasing either puts or calls. An unfortunate concept about trading options is that a trader will be profitable only if they purchase calls or puts. You can earn a profit by executing trades using a single strategy such as a purchase or sale. However, this isn't the only way to go about making money. Most strategies commonly used include multiple transactions executed simultaneously, and this is how you can profit. You don't have to stick to selling or purchasing calls alone. Instead, you can write and sell puts or calls, and you can combine all of these. There are plenty of choices out there when it comes to strategy. Trading in options is all about speculation. When it comes to trading order investment in any form, a little speculation is involved. The same applies to options as well. Trading in options is not just about speculation, but they can also be used to create an additional source of income. You can also diversify your portfolio and improve your risk tolerance by adding them with other instruments. For instant karma, if you feel the market will be trading within a specific price range, you can decide to trade options by using calendars or condors. There are different strategies that can work wonders, but a lot of planning is required. So it is unfair to limit options by believing they are solely meant for speculation. Options are the quickest way to earn money easily. If you want to attain your financial goals or start investing, let go of the notion of a free meal. The concept of a free meal doesn't exist anywhere. If you want something, you need to work for it. Trading might sound simple when looked at superficially, but if you want to be a successful trader, a lot of effort is required. You should not only understand the instrument you are dealing in. Study the market and pay close attention to different events which affect the market and instruments. You need to have sufficient knowledge and experience to become a successful trader. Let go of the notion that trading in options will make you rich overnight. There is always a learning curve, and unless you are willing to learn, you cannot go anywhere. Options are ideal only for sellers. A rather befuddling misconception about options trading is that it is ideal only for people who want to sell. Only sellers are believed to be profitable in the options market. This is nothing more than a misconception. If sellers were the only ones who could earn a profit, there would never be any options buyers. After all, contracts cannot be executed if no one is interested in purchasing. An options seller might have a certain advantage over buyers at times. However, all this is subject to change. There are different factors at play here, and at times it's profitable to purchase options instead of selling them. Whenever you are dealing with options, remember there are multiple ways to attain your financial goals. No strategy is about solely selling or buying. You will learn more about mixed transaction strategies in the subsequent chapters. Options will always expire worthlessly. It's entirely up to traders whether they want to exercise their right to buy or sell the underlying security option contracts are based on. The most common practice in an options trade is to close the position before expiry. This applies to almost all different types of options except European options. Options will expire worthlessly at times, and there will be nothing you can do to prevent it. Some trades are extremely profitable, while others don't do well. This is nothing but a risk every trader takes. However, it is simply untrue that all options expire worthlessly. In fact, there are strategies where traders earn profits if the option expires worthlessly. Now that you have gone through all these myths, chances are you will feel more confident about trading in options. It is not only interesting to learn, but ultimately quite profitable. What matters most at this point is how you go about trading and which options you choose. How are options priced? In the previous chapter, you were familiarized with different terms such as the strike price, market price, premium, time value, intrinsic value, and volatility of options. In this chapter, you will learn more about how each of these influences the pricing of options in the market. The price a trader pays to purchase an options contract is known as options premium. Three primary factors determine the pricing of an option in the market, and they are implied volatility, intrinsic value, time value of an option. Once you understand the difference between each of these, it becomes easier to determine whether any trading decision associated with a specific option is good or bad. After all, the aim of trading in any financial instrument is profitability. Unless you are aware of how much you stand to gain and the cost involved, you cannot make good trades. Whenever a buyer buys a specific premium for purchasing an option from the option seller, he becomes the option holder. The option seller is the option writer too. Options contracts usually represent 100 shares of an underlying stock of a specific company. The premium payable on options is based on the price per share of this underlying stock. For instance, if the premium payable on a single share is $5, the total cost of the option will be $500. Similarly, if the options contract is valued at $300, it means the premium per share is $3. The intrinsic value of an option is the difference between the strike price and the existing market value of the underlying security or stock. If the value of the stock of a specific company is trading in the market at $500, the value of the option of such stock is $400. If a trader has a call option for the said stock at a strike price of $490, it means the intrinsic value of the option is $10. When this happens, the option is said to be in the money. It means that with this specific call option, the investor can earn a profit of $10 per share as per the options contract. The buyer has the right to purchase an option for $390. Since the market value is $400, he can sell it at the market value and earn a profit of $10. On the other hand, the option will not have any intrinsic value if its market value reduces to $370. In a case like this, the option is said to be out of the money. If any option is out of the money on its expiry date, it has no value. Now, let's look at an example for a put option. Once again, let's assume the market price for the stock of a specific company is $400. If an options trader has a put option for said stock with a strike price of $410, its inherent value is $10. Such a put option is said to be in the money. It gives the buyer a profit of $10 for every share he owns. It means that the trader has a right to purchase an option at $400 and sell it for $410 to earn a profit. If the same trader's put option is in the same company has a strike price of only $390, there is no intrinsic value because the market price is higher than the strike price. The put option will be worthless on its expiration and is said to be out of the money in such cases. An option is said to be more in the money if its intrinsic value is high. There is a direct relationship between the price of an option and the strike price. An option is worthless if it is out of the money on its expiration. If the option expires in the money before the expiry date, it will not have any value due to the implied volatility and time value. The period during which an option expires is known as its time value. The longer the time frame until expiration, the greater its time value. Ask the expiry date of an option approach. It's time you start using it. If the option expires, it has no time value. For instance, a trader or holder of an options contract has a stock of a specific company that expires within 30 days. The option he is holding expires at money. Any contract such as this has a higher value when compared to an options contract based on the same underlying stock but with a shorter expiration date. There will be a differentiation in their valuation even when other things stay the same due to the time frame left until its expiration. The final factor that determines the price of an option is volatility. The volatility of the price of an underlying security, stock, or asset is represented by implied volatility. If the implied volatility of a specific asset is high, it means the value of the underlying security can swing in either direction. It doesn't matter whether the value of the underlying security increases or decreases. Implied volatility simply shows whether there will be a drastic movement in the value of the underlying stock or not. If the implied volatility of a specific asset is low, it means the chances of extreme price fluctuations are quite low. The higher the price of an option, the higher the level of implied volatility. Remember all these different factors before you start trading and take them into consideration while calculating the price of an option.